Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Patrick Karim. He's the Canadian arm of NorthStarBatCharts.com. I spoke to his partner Kevin just before Christmas last year, and actually, Patrick and I booked this interview about a month ago. And it's an interesting period of time that we've had Patrick in the market, especially silver. And you also are looking into oil. So, yeah, welcome back to the channel anyway.
Hi, Mario. Yeah, it's crazy seeing everything unfold because the silver chart years ago, years it was consolidating, it was showing some promise, and every time I put a bullish target out for gold, I said, guys, if this line breaks out, we're going much higher, and we're all the naysayers, and we're going to get smashed, and all that stuff. And my goodness, like it was tough. It was tough back then. And now the price is up. And if I mention anything remotely not uber bullish, people they get upset at me.
You can't win. And the same thing for silver. I saw one of your posts on X about. Yeah, I remember people saying when it was 25 and could hardly get near 30. Oh, it's going back to 18. It's never going to go to 50 again. So I wanted to start. Maybe you can bring it up because
Right.
I've allowed you to share this 125-year. Well, the second time only in 125 years we're going to have a major capital rotation. Maybe you could explain what that means to the viewers, the capital
Right.
rotation, and then look at tell us what the chart is looking like.
Right. You guys, you see my chart here? Yes, right.
Yeah.
All right. So this is important. Whenever I see somebody do analysis and they're looking at the first 5 years, 10 years, 20 years, it's not enough data, guys. You need to there's these cycles within bigger cycles, and I wish I had even more data, but look, that's all I have there. I have data going back to 1897. So what we're seeing here is the Dow Jones priced in silver, and I started using silver recently because silver was free floating back then, while gold was pegged and they unpegged it. So anything before 1970, when you do a ratio chart of pricing versus gold, it's fine. But what you're mostly seeing is the fluctuations of the other instrument we're pricing in gold more than gold's impact on the ratio chart. Because silver was free floating, then we get a little bit more realistic, more granularity on this price behavior before 1970s. So let's go do a little history recap. Here we have the Dow Jones destroying silver back in that run up, that crazy run up all the way to the 1929 blow off top for the stock market. And then it was a rapid fall down. And we call that was a CRE, a capital rotation event. So the money flows were leaving the stock market and entering while gold was pegged, they had to repeg it eventually, but silver was going up, etc., as this was unfolding. And for after this blow off top, the stock market went sideways for, I don't know, 1930 all the way to 1945. For a very long time there, it went sideways priced in silver. So you would have been better to hold silver on the run up here, and the stock market's not doing very well. Then after that, they had a beautiful gold run. So the Dow Jones outperforming silver. So from the 1940s, the stock market and silver were going up. I could probably show you a chart of this right after. So people think silver cannot go up if the stock market went up. And this is important. Back in those days, the yields were crashing, and they were bottoming in the 1940s, 50s, and they were starting to turn back up. Stock market's going up, oil's going up, silver's going up, everything's going up together, and that's fine. And it's fine for the stock market as long as the stock market is able to outperform silver. And this is critical. A bull market is when you're going up priced in fiat. A bull era is when you're going up priced in fiat, but you're also uh, going up priced in gold or pricing up in silver or priced versus another major asset class. So this was a bull era it was a nifty 50. It was like you could do no wrong. The stock market started topping out here and rolling over in the late 50s, early 60s, It wasn't able to do a new high versus silver, kind of like what we did today there in 2023. The stock market's still going, still doing new higher, like higher highs, higher than the 2017 or 18, but it's not able to do new highs versus silver. And that's step one. Same thing happened here back in the late 60s. The stock market was still going up, but it wasn't able to do new highs versus silver. And that's the underlying weakness with those yields going up, with money flowing into the precious metals, the commodities, absorbing more of that capital. That's the first sign of vulnerability. And after that, here, huge drop in the Dow Jones price in silver, huge drop today, but it doesn't have to be played like that. We love seeing analogies, right? Or analogs, like our brain's wired to try to repeat patterns, but it, so far it's repeating that silver is destroying the stock market while the stock market hasn't imploded yet. And when this thing went down here, the stock market was also still going up a little bit, just like it is today, while silver is outperforming it. Then we get the transition period where this little period here, I don't know how long it's going to be. I squished it. What I did here, I reproduced what happened in the 70s, late 60s, 80s. I just put it here just to give a ballpark. We'll always adapt to what the charts are actually going to tell us. So right here could be a period where, look, silver stretch, gold stretch, the miners are stretched, everything's uber stretched. It could be hitting this 45-year line, one touch, two touch, three touch, four touch. It's a good place where you could imagine silver, gold, starting to correct. Either the market's going up marginally or going sideways a little bit more, but having this ratio, we go up a little bit. So let the relative performance of the Dow Jones reflate versus the commodities right now. This is just a huge drop. Look, I don't know if the bottom's going to follow here, but I would expect some type of bounce on this line. And after this line, this beautiful line, here we had the one, two, multiple touch points, and this is on a quarterly basis, right? So this will only at the end of March, January, February, March. At the end of March, will we know where this lands, right? It could go below intra quarter. Once we close, whatever happens here, the next bounce, the correction for silver, gold, when the bottom falls through out here, this is what we call a super capital rotation event. So here's the 1930 capital rotation event. Here's the dot-com bubble capital rotation event. And like a huge move up, huge move down. And now we had a rounding top for the performance of the Dow versus silver. And once that falls, man, I don't know, whatever we thought, whatever price is silver at when this falls, whether it's at $100, 150, 80, whatever it is, it's going to do much, much, much better after this. The stock market here lost 90% when priced in inflation, when priced in CPI. And the stock market might go, and all this inflation, people sometimes they expect the stock market to go down 80, 90% or 70. What happened in the 60s, the stock market did not go down that much price in fiat because all that, the yields, all that interest rate going up, all that's fueling the destruction of purchasing power, which the commodities are reacting to, that will keep a floor in fiat terms. I call it the fiat illusion. It's, they're going to print so much that the stock market might go down just 30%, then another 50, and then another 30, but always like rebounding and just like going sideways for 14, 15 years, like in this stagflation area. But it's going to get destroyed versus inflation, versus probably oil, versus silver, gold. It's probably going to lose 80%, another 80% of its value. And that's the best years. It's so early, Mario, there. The best years for gold, silver are after here, or after we break down from this line. That's 5-digit gold, whatever, $500-600 silver. It's after this line here. So this often, guys, we get people say, sometimes I put out, let's say, a bearish roadmap for silver. So it's time to correct on the daily chart. Guys, it's all about time frames. This roadmap, I don't know what you could call it there. It's like the biggest roadmap I could ever build for you guys. This is a 10-year, 15-year roadmap. So if you have that time horizon in your head, whatever you're a stacker or a very long-term investor, this is the type of roadmap you're going to want to not fight, right? You're not, but I would get long U.S. equities if ever. There's probably a line here, Mario. There, like if ever the U.S. equities versus silver are able to get back above, this greeny Chimook cloud. Okay, I was wrong. My timing's off. Take this roadmap, and say, look. But right now, we're really, really angling for this to play out, especially with the yields. Just they're starting to do the same thing that they did back in the look. I have to show you the yield chart. There's no way I cannot show you those yield charts. So this is the 1913. Okay, I like that one. So here I have the yield chart, the move drawing indicators. So here's the yield chart, and I'll overlay the silver chart. Say GUSD, move plane. Always, guys, always put log scale because you won't see. And this is what I want to show people. The yields are going down, silver's going down. The yields are going up, silver's going up, right? So this is a huge thing that happened back then. And right now, the yields are starting to turn back up. We're starting to put a bottom here. The yields are going back up. And that's why this move here is going to be more analogous to the move that we had back in the 60s. So now it's a macro yield interest rates going up, driving silver price, and not a move like we had in the 2000s, which was not driven by this macro flow, right? Because the yield was still dropping in the 2000s and the silver had to rally upwards. So this is like, it doesn't get bigger picture than that, Mario, that huge macro landscape look at this thing. Oh my goodness. It's like, let's put that down here.
Yeah. Also on the previous chart, you copied what happened in the 70s and you transposed it to now. And it, you know, it doesn't necessarily mean that this will happen. We could break that line even this year, couldn't we? I mean, this is just
Right.
trying to be safe, I guess.
Well, this is how tricky it is for like a mathematical. Let's just put the silver chart. Let's
Yeah,
review
but the yield is really interesting because yeah, that's how it should work. Higher yields means there's more inflationary pressure, and silver should perform well there. And I personally think, Patrick, I don't know what you think, that the 40-year bull market in bonds or bearish, bear market in yields is over, and we're going to continue to see higher yields, even though
yeah,
they
yeah.
seem to have been under control for the last 3 years.
Yeah. It's just been consolidating now sideways. The trajectory for yields is higher highs, higher lows, and until that breaks, then the bias is higher yields, and that's the recipe. Every time the debt to GDP is high in the 70s, the debt to GDP actually lowered via inflation. We're able to raise the GDP artificially or whatever through destruction of purchasing power, and that actually helps keep that ratio in check there. So that's going to be the recipe. Here's a silver chart, and at the bottom pane, I had the distance of the silver price with the. I don't want to update. Why do you ask me? The distance of the silver price with its 36-month moving average. And it's crazy the move we had. We are uber stretched higher than we were stretched back at the no, pretty much getting close to how stretched we were back at the 2011 peak, and now we're as stretched as we were back in the mid 70s. So this is why I tell people that as long as this rising line here is intact, it's all good. There's no important correction on the monthly chart. There's no multi-year correction that has been enacted as long as we rise that. It's just once we lose that line, I don't know, as soon as you lose that line, then you're going to be entering correction mode. Every single time we lose a rising support line of this nature there, it's like let me put some vertical rays. So like, this keeps me sane because the bullish narratives, when price goes up, people have more courage to pronounce their convictions, right? And it gets like, it's the people who it gets really, really bullish out there. And the only way I could spot an eventual turnaround is using the charts. It's like it's my sanctuary. It's like this is how I can sleep at night because
Yeah, and what about Patrick, the fact that this cup and handle of 45 years is
oh,
being finally broken, the
yes,
top.
look
Uh,
at this.
I mean, it's quite a significant,
Oh,
it's been kind of, you can say it's been suppressed or, for 45 years, and now it's broken out. And one would expect, oh, it's going to take years now to play out, but I think it's almost like they've kept a beach ball below the water for 45 years. Now there's so much pressure, and now it's going crazy. I agree with you. There will be corrections along the way, but I think the trend is going to be a lot higher. And I guess those same people who said silver could never go to 50 again, they're going to be the ones calling major tops. Is that the way you see it?
yes. So, all right, guys, let's look at a big time frame. This is the yearly silver chart. Yearly. I remove a whole bunch of noise because often I remember silver's peaks $50, but when I was putting the chart on the yearly chart, like even back here, I was already starting to do yearly charts when in 2019, 20, I was already spotting, this handle turning up. But I noticed if you put it on a yearly close basis and you remove the noise, you remove blow off tops because they don't last a long time, right? You shouldn't judge the silver price on a blow off top because it's just a crazy number that was very short lived. It was very volatile. Not many people traded there. So by putting on yearly candle, you kind of remove all that all that noise from the top. You see more of the meat, like where did this really the transactions happen. So here we have this area here, 31, 28, $30 back in the 80s. Here after that, we halted at 31. And here, even here in 2011 or 12, there we had this crazy move up, right, to 48. But look where it closed the year. The market for 1, 2, 3, for 4 years, it wasn't able to close above that. It's meaningful. So now you know $31 is like 31, 32 is like a cap
Yeah,
for the
and I
market.
guess that, Pat, sorry to interrupt you. I guess that's why, like in 2021, we were testing that 30 level.
Yes,
And I
yes.
guess that's why it took so long to break that. So, like, maybe the 30, 31 was even more important than the 50.
I think so. 100% more important. Oh my goodness, you're so that's why I don't know. I did tons of charts. I could show you some when we had that breakout out of 30, like there was a huge consolidation we had there. I'll have to show you this then. It's good to study this there because it's people could remember and the next time it happens, well, this in their lifetime, once we got that close here, let me just move one of these here. Yes, the 31 here, the 31 level was way, way more important. That wall here, 20, oh, that's on the quarterly chart here and here. As soon as we got through this congestion area, I'll put on the monthly chart. Reset chart view. There's a whole bunch of ways you could draw this, but I think this pattern here, when that broke out here, this consolidation pattern, and we got out of here 33. So this was the embryonic breakout. It started all here, and after as soon as we got out of here, that was if you were waiting for 50, it made no sense. That's not where the breakout was. The breakout was back down here. That's when we had to be the most bullish ever on silver is on this quarterly defined breakout, on this monthly defined breakout. That's when the bullishness we feel today should have been felt back then if you were looking at the charts. That's when say, guys, look, this is a paradigm shift. This is the market's changing, telling you the odds are now that we're going up instead of going down. They drastically change once you're above this line here. And once you got through this little congestion area, you could even be more bullish here. You had an aggressive, it's not at 50. It's like at 50, people are looking at these tops here that there's practically no price action there. No, they're not. I'm not impressed by that number there, but this here and here at 35, that was your last chance. Without no, that was the move.
Yeah, I remember 35 was touched a couple of times and it failed. And then the third time
That's right.
it broke out.
Look
Yeah.
at that right here. You have a wall here. This I love. I call these walls blow off top support. When that support fails, it becomes resistance, resistance, resistance. Look at that. This, it's like a pivot line. Those lines are way more meaningful. There's a lot of hands of transactions happening here. It's way more important this here than this here when there's practically nobody that ever traded here. It's like a blow off top. Okay, it's done. It's like, but this is way more meaningful. And look exactly what happened years later when we broke from that. Bam. It's like
Yeah.
you popped the pimple, whatever your expression, the volcano, Mount St. Helens, whatever, it just shot up. And this is the dilemma for silver right here.
Yeah.
It broke up. It broke out so fast and so powerful that we got a yearly defined breakout. And at the same time, at the same time, this smaller pattern target, classical TA measure target is already reached. But what has happened now, we've enacted this B target from a classical, it doesn't mean time to go higher. This is just a class. Okay, I have to take just a little time to explain the difference between a classical TA analysis and a trend analysis. A classical TA analysis, it's all about measuring moves. I have my pattern. This is my beach ball, the energy stored. And once I break out above that neckline, all that energy stored, I replicate it on the top side. A classical TA guy will always exit into strength. It will always feel long because he's not a trend follower. He doesn't care if the trend continues after he exits. I'm measuring that move, and that's my target. So this target here from the handle, the target is moved, it's done. But at that breakout has also enacted this move here, which is now the target that long-term players should look at. And that's at least $275 from the classical TA measure moves. Now the trend to keep going up after that, and then the classical TA guy is going to have to wait for some type of consolidation pattern. He's going to have to wait for some type of like, a cup, a handle, a pennant, whatever, a few years of consolidation for him to get back in. But the trend followers, they're good. The trend followers have entered maybe even here at 25 when the trend started turning upwards. They might have added here maybe at 33, 35 after this consolidation ended. And they're going to ride this thing until the end of time if need be, the next 10, 15 years. Or if we go back to that first chart, right, when the Dow finally bottoms versus silver, the trend followers, they will start exiting like way down the line.
Yeah.
Right? The classical TA measure moves, like, look, if we had a GFC event, we could go sideways for a year, down 30%, then up, sideways for a year. In the 70s, we had one red candle here, went sideways for a couple of years, There's a wick here, that's a huge correction, along the way. So
Yeah. And I guess would you say that once we reach really low targets on that Dow silver ratio, that's when the bull market would be over for silver? A little bit like the Dow gold ratio. Some people think of 1 to 1 or even half to 1.
yes, let me show you that.
Yeah.
My goodness. Okay, here I did this for the members, but I'll show you guys here. Where is it here? The gold silver ratio. I just did that, a historical gold silver ratio. All right, so gold silver ratio for since 1931. Here is the super CRE, how it looked like. So the gold silver ratio was actually going down a lot, much lower levels, but gold was also pegged. So this was mostly the silver price driving this down. Like if gold's pegged and silver price goes up, then this ratio might artificially go down. You know what I mean? It's like sometimes people look at the gold silver ratio and they see this, 19, or this is a quarterly close basis. And people, they see that 25 to 19, but you got to remember, this was primarily silver driving the gold silver ratio. But what I'll bring your attention to is just, doesn't matter that how low it went, but the structure. So here you have a peak in gold versus silver, it goes down, bottoms, and as this goes up, so as silver is not outperforming gold, you have a super CRE. And why is that happening is, and you had it here in the 2000s, it's the stock market weakness is creating some hiccups for silver, whatever, silver's industrial demands or whatever reason, gold holds better its value. Gold is like the grandpa of precious metals. Like if you don't want no stress, just buy gold, guys, and don't have to worry. People
Yeah.
want to increase their stack of gold and silver, they could play that gold silver ratio. So we had here the setup here, same similar setup. The GSR goes down, silver's totally destroying gold's performance. But as soon as that stops, and we're entering a congestion area, it hasn't quite turned in gold's favor. It hasn't turned at all in gold's favor yet. But here you could expect some type of slowdown for silver's performance versus gold. And then we watch. Then we see if the stock market starts showing weakness, like is it the thesis, the super capital rotation thesis, and stock market starts rolling over, gold is most likely going to hold out much, much better than silver, having gold regain value versus silver. And remember, it doesn't mean silver is going down the drain. It's just that gold going up more, right? It's a relative ratio
Going up
chart.
faster than silver, maybe, or yeah,
Yes, that's all it means. A ratio chart,
yeah,
guys, is just which ones.
yeah.
This has no indication right now. If you just read that, it's not telling you if silver's plummeting or silver's going up. And then after that, during the whole bull era here for gold and silver, they kind of trade hands. The gold initially does better than silver, then silver does better than gold. And if there's a huge correction halfway through, then gold will do better than silver. But what is the common indicator? And to your point, it's when there's a the final crash in the GSR. So when silver really goes parabolic there, and everybody's like the holy grail of moves, and gold is not able to follow it, and these blow off the bottoms in favor of silver, that's the end. So right
Yeah.
now, I don't think it's that we're at the end. It's just the instigator move that's going to lead up to a reflation in the GSR, and then we just might go sideways or have a lot of volatility here where it's time to hold gold, and then it goes down, time to hold silver, then time to hold gold. But the true, like, end game marketplace and the end game for the precious metals will most likely be with a total dominance by silver, like just too crazy of an outperformance of
Yeah.
silver. That could signal 100%, that could signal the end. So I don't think this is the end. It could just be the beginning, but it needs to reflate up.
Yeah, yeah, no, I agree with you. I don't think we're anywhere near the end because, like in 2011, we got down to around 30, and there's so much more leverage and debt right now in the system that I can't see it being the end. But like you
Okay.
said, nothing goes up and down in a straight line. You could have a correction in it. Maybe we could talk a little bit about oil now, seeing that
Yes.
what's happened this week geopolitically. And I don't know if you follow fundamentals of geopolitics. Like, for example, in silver, there's a lot of talk that the paper market is losing control and that the silver is becoming much more of a physical commodity. But I guess that would be priced into the charts, right? That's
Yes.
that.
Yes. So I do follow, like I listen. There's no way I cannot hear all this, all the news because it's on my feed and a lot of my followers, even members on the website, they'll mention it to me, and there a lot of people like I won't say believe in it, but they follow it and it's part of their thesis and it's important for them. And I understand that. But again, because maybe my brain is not I have to stay sane. The theory is exactly like you said, the chart is the aggregate of all the millions of analysts out there, all the millions of people telling their boss what to buy, what to sell, the pension fund, all that stuff. I just, it's all in there at the end of the day, right? It's like the manipulators, the suppressors, but also the people taking the hedge on the opposite side. They're in the chart, right? Eventually, they have to buy. So, and that's how we can make money is playing those price charts for whatever reason they're moving or not.
Yeah, that's right. So
I
what?
just
Yeah, go ahead.
so here I put back the silver yearly chart. I know we're going to talk about oil. And
Yeah,
then I've overlaid the oil chart. And check this out. This is the oil chart from the data going back to 1861. And
wow.
look on a yearly close basis how well it tracks silver. Look, there's some years see silver went up, oil did not do anything. There's some years that
Yeah,
oil went up, silver plummeted. But if you take a bird's eye view and you remove a lot of the noise, we have a situation now where silver's up, oil is not doing a new low on a yearly close basis, it's still doing a higher low. I kind of
it
see an opportunity here.
sorry to interrupt you. It looks very bullish for oil, that chart.
Goodness gracious.
because we've ascertained that silver is, it can correct, but it looks like it's in a definite bull market now. So, and yeah, I had a look at the oil chart. I usually haven't been following oil much, but with what's happening geopolitically, I had a look at it, and it looks like a long-term falling wedge, which is actually bullish. It's just a matter of time, I think, uh, until we see oil pick up again.
But until whatever next implosion in the recession, the unemployment rate is still going up. People are sleeping on that. Like the unemployment rate has broken out there. It's like at 4 dot. I had a breakout line at 4.1, 4.2. That and now it's at what 4.6. The only thing keeping a lid on that is probably the initial jobless claims, which for some miracle that number has refused to break out. I have a breakout line at 242,000 initial claims. So if ever we start getting, initial jobless claims higher than 240,000, then we could have a breakout. Like, I don't know, maybe that's a number that will get revised later on, and then with hindsight. But yeah, look at the big long-term picture for oil, for gold, for silver. It's up, up and away there. It's, not all entry points are equal. So I'll remove just so I'll hide the silver chart. Just let's focus on the oil chart. So that thing here, if oil, and now it's coiling, coiling. As soon as oil, I'll zoom in there, but like I'll just put the oil chart because let's just put the oil chart. Okay, here's the oil chart. So oil, move that. It goes here. Okay, here we go. So here's an important level for oil. Here is a descending. So oil, the breakout line for oil is not that far away there. Where this is the beauty. Okay, this is the beauty of the oil chart. Nobody likes it. It's been coiling and tied in since 2007 on a year to close basis. That's the same thing that happened to silver there. These huge patterns, these huge sideways pattern there. My goodness, God! Like when these things break out, they generate huge moves. Look at that, 135%, like super fast, and then sideways. And then what do we get here? We got 1,000%. And here, what do we get? We got on a year to close basis. If I would go on the smaller time frames, it's probably higher. Here we had a 260%. So this pattern here, once you break out there, that's why when I say $300 oil and people get upset at me, guys, that's where we're going, man. That's where we're
Yeah,
going.
maybe it could coincide with some geopolitical event in the Middle East.
Well, whatever it's going to be, the market participants, the owners of these oil companies, they're going to sense it, right? They might start like everybody who's when this thing is mature and ready to pop, we will know. We will know, Mario.
Yeah,
There, just follow my feed there, or just
I,
once oil starts closing above 73, 75. Oh man, in the pressure cooker, just like when silver was hitting that 30 nonstop right before it broke out.
yeah,
This is crazy there, and there's
and
some
I
crazy
think
oil charts out.
sorry to interrupt you, Patrick. I think that will confirm, like, because for the last 5, even 6 years, I've been saying that we're going from a world of financialization to hard assets. And we have to some extent, but I think the only thing keeping the general commodities kind of, if you look at it as an index, the only thing keeping it down for now is oil. But once this breaks, it's all full speed ahead, and
Giving me
for
shivers
all the
listening to that, Mario.
commodities.
It's giving me shivers because oil is inflation. So the fluctuations in oil is like it's the inflation rate, the month over month or year over year inflation rate. But oil, the price of oil is a compounded effects of inflation in its own price chart because it tracks inflation, but because inflation destroys purchasing power, nominally the fiat oil will fluctuate to the rhythm of inflation, but it compounds that. So next time we have an inflation, that yield chart there that keeps going up, well, CPI is going to be going up because the rates can't go up if CPI is not going up. And then inflation, and then the oil price also is a huge driver of inflation, right? Because
So
that guy
yeah,
goes next to the market, well, he has a truck, right? And then he's going to need to buy that costly gasoline. He'll have to give that price off to the consumer. It's like we all lived a micro version of this back in COVID, right? It was
yeah.
like a snapshot into the future, what happened in COVID, that inflation, right? That spike.
So
So
I get,
this,
yeah, I guess we need a close on a monthly basis above like 73. Is that the
oh,
level?
that's year. This is the yearly chart. So
Yeah,
let's look closely. Reset chart. Remove all drawings. Remove all indicators. Right now, it is. It's almost like oil is pricing in a deflation event, and this is what's tricky about the markets, guys. This is what's tricky. We could already the fact that oil is going down. It it could be also telling you we're already in a recession, and they will backfill it by the time it starts, and it will already be bottoming, and people won't understand, hey, oil's going up, the recession's gone. Well, it might have already bottomed halfway through the recession, and then look, I'll overlay recessions. Recessions. Sometimes oil goes up during a recession, sometimes it goes down.
yeah,
Here's
maybe it's forecasting a recession already, and then when it starts turning up, it's forecasting the fact that the central banks and governments are gonna reinflate the system.
yeah, the recovery. Yes, exactly. Look here. But this could we could be in the early 2000s here or late 1990s. Reset. Oil takes a dump, and then after that, it's known that recession. And this recession was back from I asked ChatGPT this a while back,
Yeah.
and
That's why I think it's important to this non-farm payroll number coming out this Friday is going to be really key because I've heard people say that it could be a very weak number. So if it wasn't for AI, like those data centers, I think GDP would be a lot lower. So yeah,
look at that. You're right, 68. If we start getting closes above, well, even above that descending trend line, people have to, if this descending trend line gets closed above at 63,
yeah,
people need to start paying attention. Then we're probably going to retest here.
yeah.
It's probably going to look like that then.
Yeah,
So
and this is WTI, right? Not Brent.
yeah, it's WTI. I like using also USL, USO. Yeah, USO is kind of fun also. USO is no, not USO. USL. Oh, here. USL, what it is, it's the US Texas sweet light crude oil thing, but it's not just the current futures contract, it's the next 12 month. So it's a January contract, February contract, March for 12 months. So it kind of smooths out the volatility. And you see it looks much more bullish, right? Look how because it's including the future price of December of the end of the year, right? Or the January price of 2027, it's not as deep as the just the
Yeah,
next contract.
and it looks like a bullish consolidation pattern as
Well,
well.
yeah, well, and once we get a close above, that's why I have an alert here at 39. I might actually lower my alert.
Mm.
But that is the bullish pattern of that's going to launch everything. It's this here there. So if this instrument, the USL, starts closing above 38.40, we have something important on our hands. You got to
Oh,
look also like, even some of the oil plays, they're not giving up. Look at that's Exxon. Look at
yeah,
Exxon.
yeah,
Look at
yeah,
it. That's not bearish. We
yeah,
don't always track oil. Sometimes they'll go up while oil's not going up and whatever, but they're not falling apart. They're Shell oil, another one. And adjusted for dividends, these things have already been giving you. Shell
yeah.
oil has a huge pattern here. It's like, look at that thing there. That's
It reminds me of even the copper, long-term copper chart, which we've
yeah,
broken out of.
that copper also. Look at that
Yeah,
thing.
yeah, there you go.
So, yeah, copper's fine. There's
Yeah,
no problem with
yeah,
copper. It could do a 2008 type of move
yeah,
down.
yeah. It looks like
But
those oil company charts anyway.
Yeah.
Um,
So oil is the probably the hidden gem here. Like for the people
mm,
who miss, I guess, gold and silver and are starting this copper, then there's still oil that's gonna be a good play there.
yeah. And Patrick, maybe if you have some final words for the viewers as we wrap up here. I
So
mean, we're looking at charts and technicals, and it's good for traders, but do you also hold physical gold and silver as well as insurance, or is that something you don't do?
no, no, 100%. So people have to decide where they are. Sometimes when I put out content, it doesn't apply to, it's not a one size fits all. I might put a chart out there that's for traders, one a chart out there that's for stackers, one for investors, position traders. Sometimes also we have this thing called a dynamic portfolio manager. So let's say I was forcing you to choose between gold, stocks, cash, or bonds, then you could have an allocation in between those four and rotate as as you see fit there to but right now I think we're like from that those four asset classes. I'm pretty sure I think we're like 60% gold, maybe 40% stocks, or maybe change a little bit, maybe 16% cash. uh, but yeah, 100% gold. You have to have gold in your portfolio
Yeah,
somewhere.
yeah,
I don't think anybody should not have that, because it will all if you replace a 60/40 portfolio and you put in gold in there in that mix, you're gonna be way better than just a 60/40 there. You gotta
yeah,
have some gold in there.
yeah. And
No
Morgan Stanley.
financial advice, guys.
No, but
You
Morgan
need gold.
Stanley as well. They changed their allocation last year from 60/40 to 60 stocks, 20 bonds, and 20 gold. Uh,
Yeah.
I think 60 gold, 20 stocks, and 20 bonds is better. And I think people need to start thinking more and more about general commodities and oil as well. I've been hearing from friends that are into gold and silver, but that they're looking into oil now, oil companies. So I think that could be a big trade for 2026. I think oil. Anyway,
Yeah.
Patrick, it was great speaking with you, and hopefully we'll speak more regularly in the near future. And thanks again.
All right. That was fun, Mario. Yes. Talk to you soon.
Take care. Bye.
Bye.